Welcome to episode 14 of our series. Today we are diving into one of the most critical concepts for long-term fundamental analysis, economic moats. Over the next 22 slides, we will break down the 5 distinct types of competitive advantages identified by Morningstar. We'll look at why some companies manage to stay on top for decades while others fade away, and how you can use these structural defenses to filter your own investment choices. This is the core of finding high-quality businesses that can compound your wealth over the long haul. So let's get started. Warren Buffett famously coined the term economic moat in his 1986 Berkshire Hathaway shareholder letter. He described great businesses as economic castles, protected by deep, unbreachable moats that keep competitors at bay. In any free market, the prospect of excess profits acts like an invading army, drawing rivals in to capture that value. Only companies with durable, structural defenses can sustain above-average returns in the face of this competition. Since 2002, Morningstar has used this exact framework to rate the competitive strength of every U.S. stock it tracks. When we look at the data, the benefits of these moats are clear. As of January 2025, the Morningstar Wide-Moat Index shows a trailing 12-month return on invested capital of 32.1% and a return on equity of 40.1%. For context, the S&P 500 managed 26% and 33% respectively. Narrow moat companies trailed further with 10.1% and 18.9%, while firms with no moat at all scraped by with just 5.8% and 12.2%. The gap in capital efficiency between the best and the worst is more than fivefold. Morningstar classifies these defenses into 3 specific ratings. A wide moat indicates a competitive advantage expected to persist for 20 years or more, a status held by only about 10% of companies. A narrow moat suggests an advantage lasting between 10 and 20 years. Finally, a no-moat rating means the company has no durable edge, or any advantage they do have is likely to dissipate quickly. The 20-year threshold for a wide moat is intentionally rigorous. It requires a high degree of confidence that the company will continue to earn returns on invested capital that exceed its cost of capital for 2 full decades. There are exactly 5 sources Morningstar uses to identify these advantages. First, intangible assets like brands, patents, and regulatory licenses. Second, cost advantages, where a firm produces goods more cheaply through scale or unique processes. Third, switching costs, which create friction for customers trying to leave. Fourth, the network effect, where a service grows more valuable as more people join. Fifth, efficient scale, which occurs in markets too small to support multiple profitable players. Every single wide moat company on the market derives its strength from at least one of these 5 pillars. Let's look at our first type, intangible assets. This category covers brand recognition, intellectual property, and government-granted licenses. Coca-Cola is the definitive example of a brand-based moat. They manage a portfolio of over 200 beverage brands across more than 200 countries and territories. Their flagship trademark is arguably one of the most recognized consumer assets on the planet. While they do benefit from a secondary cost advantage due to their massive global manufacturing and distribution footprint, Morningstar grants them a wide moat primarily because of their immense brand power. That brand strength shows up clearly in the financial statements. In fiscal 2024, Coca-Cola brought in roughly $47 billion in revenue with a gross profit margin of 61.1%, up from 59.5% the previous year. Models suggest operating margins will climb to 31.2% by 2034. With returns on invested capital averaging 37% against a 7% cost of capital, they are clearly thriving. They also invested over $5 billion into advertising last year. That is 11% of their total sales to ensure that their century-old moat remains impenetrable. Our second type is cost advantage. This is the ability to produce or deliver goods at a lower cost than anyone else. Walmart is the king of this, using economies of scale that are simply unreachable for others. With roughly $713 billion in fiscal 2026 revenue and $483 billion in U.S. net sales, their leverage over suppliers is unmatched. Their stores function as local fulfillment centers, creating a logistics density that would cost billions and take decades for a rival to build. Despite the thin margins inherent in retail, they generated $31 billion in operating income by turning absolute scale into absolute profit. While Walmart's gross margin of 25% looks modest compared to Coca-Cola, that is expected in the retail sector. The real moat lives in the gap between Walmart's costs and its competitors. To challenge them, a new firm would have to simultaneously match their supplier terms, their distribution network, and their 270 million weekly customer visits. That is a nearly impossible barrier. You see this type of moat most often in industries where scale compounds, such as semiconductor manufacturing, commodity chemicals, and retail. The ultimate test is whether the cost gap continues to widen as the company grows. Third is switching costs. These exist when it is too expensive, risky, or time-consuming for a customer to move to a new provider. Apple is the master of this in the tech world. As of late 2025, they have an active installed base of over 2.2 billion devices. This creates a compounding effect. 88% of their users own an iPhone, 73% own an iPad, 58% own an Apple Watch, and half own a Mac. Each new device added to a user's collection increases the friction of leaving, not just in dollars, but in the loss of seamless integration and data migration. The data on user behavior is striking. Apple's iPhone retention rate is over 92%, compared to 77% for Samsung. When a user owns 3 or more devices, the probability of switching drops significantly. This stickiness allows for the sale of high-margin services, including the App Store, iCloud, Apple Pay, and Apple Music. This division generated between $95 and $100 billion in fiscal 2025, with gross margins exceeding 75%. The moat here is not about a single gadget. It is the total accumulated friction of replacing an entire ecosystem of habits, data, and subscriptions. Fourth is the network effect. This happens when a product becomes more valuable for every user as the user base grows. Visa is a perfect example of a two-sided platform. They don't issue credit cards themselves. They provide the infrastructure connecting banks to merchants. In 2025, VisaNet processed 257.5 billion transactions, totaling $14.2 trillion. They operate 4 secure data centers in Virginia, Colorado, London, and Singapore, which are capable of handling 30,000 simultaneous transactions and 100 billion computations every single second. This is a self-reinforcing loop. New cardholders make the network more valuable to merchants, and new merchants make it more valuable to banks. Outside of China, Visa holds roughly 50% of the market share for card payments. The switching cost for a bank to change networks is huge, requiring them to reissue millions of cards and retrain staff, which adds a layer of protection to the network effect. While competitors like MasterCard and American Express exist, Visa's massive scale creates a durable edge that is incredibly difficult to disrupt. Our fifth type is efficient scale. This applies to markets that are limited in size and can only support one or a few players. Union Pacific, which serves the western United States, is the classic case here. They operate across 23 states with a network that would cost tens of billions of dollars and take decades of regulatory approval to replicate. Because freight demand in any corridor is finite, a new entrant wouldn't grow the market. They would just split the existing volume, driving returns below the cost of capital for everyone. This reality discourages new competition from even attempting to enter the space. Union Pacific's financials demonstrate the pricing power that comes with this natural oligopoly. They maintain a gross margin of 55.6% and an operating margin near 40%, which is elite for an industrial firm. Their 5-year average return on invested capital sits at 17.4%. In 2024, they allocated $3.4 billion to infrastructure and technology, a level of spending that further reinforces their moat by keeping their network quality beyond the reach of any challenger. You will typically find efficient scale moats in railroads, utilities, pipelines, and telecommunications. Some companies combine these sources to create a multi-layered defense. Apple is the perfect example of a triple moat company. First, their brand intangible assets allow for premium pricing. Their average iPhone selling price is roughly $987, compared to the industry average of $300 to $400. Second, Their switching costs create structural retention across their 2.2 billion devices. Third, the network effects of their App Store and iMessage become more valuable as more people join. These sources do not just add up. They multiply to create a fortress that is extremely hard to attack. You can see the fingerprints of this triple moat in their financial statements. Services revenue made up roughly 41% of their gross profit in 2025, despite being only 26% of total revenue, because those margins are over 75%. Their fiscal 2024 return on equity was 164.6%, and return on assets is forecasted at 35.2% for 2026. Apple captures 62% of the smartphone segment priced above $400, and 78% of the ultra-premium tier. These numbers are the measurable result of their structural advantages. As of June 2026, Morningstar covers 875 U.S.-listed stocks. The distribution of these ratings shows how rare true durability is. Only 215 stocks have a wide moat, while 367 have a narrow moat and 293 have no moat at all. In percentage terms, that is 25% wide, 42% narrow, and 33% with no moat. Keep in mind that this list already skews toward large, successful firms. In the broader economy, most companies have no moat at all. If you find a wide moat company, you are looking at the top decile of quality. Moats are durable, but they are not permanent. You should watch for 4 warning signs of erosion. First, a multi-year trend of declining returns on invested capital. Second, technological disruption that bypasses the moat entirely, like how streaming destroyed the geographic monopoly of cable. Third, shifts in customer behavior, such as health-conscious consumers moving away from soda, which threatens brand-based volume. Fourth, regulatory intervention that forces a closed network to open or invalidates patents. Moat erosion usually shows up in the underlying business metrics years before it is reflected in the stock price. When you're analyzing a 10K or an earnings transcript, ask 3 questions to spot a moat. 1. Does the company earn returns on invested capital consistently above its cost of capital, and for how many years? A single good year doesn't count. A decade does. 2. What would it cost a well-funded competitor to replicate this business exactly? If the answer is billions of dollars and decades of effort, you likely have a moat. 3. If the company raised prices by 5%, how many customers would leave? The fewer that leave, the stronger the pricing power and the wider the moat. Remember, an economic moat is not an automatic buy signal. It is a quality filter. A wide moat company trading at a massive valuation can still be a terrible investment. Use this analysis as a first screen to narrow your focus. Once you identify a company with a durable advantage, apply the valuation tools we covered in episodes 11 and 12, like the price-to-earnings ratio or discounted cash flow analysis, to see if the market has priced that advantage fairly. Moats tell you which castles are worth inspecting, but valuation tells you whether it is the right time to buy the keys. That wraps up our look at economic moats. Understanding these structural advantages is the best way to ensure you are fishing in the right pond when searching for long-term winners. Next time in episode 15, we are going to pivot to the dark side of fundamental analysis. We will be looking at red flags and signs of potential fraud. We will examine real-world cases like Enron, Theranos, Wirecard, and FTX to learn how to spot the warning signs that are often hidden right there in the numbers. I will see you in the next episode.